In today's video, we're going to take a look at the top 10 most common holdings of super investors like Warren Buffett, Bill Ackman, Terry Smith, Dev Kantesaria, and the like. I do this on a quarterly basis to get some insights into what the best of the best investors are thinking, and to find new ideas for my own portfolio and to either confirm or challenge my own analysis. Not surprisingly, half of this top 10 is comprised of Mag 7 companies, of which we're all very familiar. I'm going to be very brief with these stocks. I'm not going to spend too much time on them because there's other stocks that I want to focus on. And there's one stock in here that you're probably unaware of. I know I've never talked about it, that I think is a great, often overlooked wide moat company. So make sure you watch the entire video. All right, let's get to it. The stock that is most commonly held by these super investors is Google, ticker GOOGL. Out of 78 portfolios, half of them held Google as a top 10 holding, which makes sense to me. It's one of the best bargains in the market right now, trading at a 19 forward PE, and is trading at the lowest PE of all Mag 7 stocks over the last 5 years. They're a highly monopolistic company with significant advantages in search and video. In fact, Google leads all video platforms in views and watch time, greater than Netflix, greater than Amazon Prime Video. Additionally, they've made significant inroads in the cloud computing space, consistently taking market share from Amazon over the past couple of years. In fact, they've doubled their cloud revenue in only 4 years, and over that same time frame, their cloud operating margins have been on a tremendous march upwards, going from minus 16% all the way up to positive 17%. Revenues and free cash flow are growing in the mid-teens, which is comparable with the other 4 Mag 7 stocks on this list. Profitability has been consistently increasing across the board. Even with massive capex on AI, their return on invested capital is expanding beautifully from 18% in 2020 up to the current 25% baseline. Surprisingly, they've been returning immense amounts of cash to shareholders over the past 4 years. They returned $70 billion to shareholders in 2024 alone. The only publicly traded company that has returned more over the past 4 years is Apple. Because of all this, Google is my number one holding right now at 11% of my portfolio. Don't get me wrong, I'm concerned about the competitive and regulatory pressures on their search business. Not only are large language models intruding on search from every angle, the regulatory concerns about a potential breakup of the search business still exist. At this time, my eyebrows are raised, but I'm not materially changing my position. The next Mag 7 company comes in at the third most common holding amongst these super investors, and that is Microsoft, ticker MSFT. The old desktop software company that has transformed itself into a dominant cloud computing and SaaS company, with 330 million subscribers generating massive amounts of sticky recurring revenue that's growing in the mid-teens. Microsoft has built an extremely wide moat centered around their enterprise software ecosystem, comprised of a network effect which is fortified by unassailable switching costs. They also bring world-renowned brand recognition and loyalty, and Azure has also been taking market share from AWS in the cloud computing market, which has been growing 23% per year over the past 5 years. The main drawbacks with Microsoft are good but not great shareholder returns. They returned $39 billion in 2024, which is a ton of money. But when compared to Google at $70 billion and Apple at $110 billion, investors are left feeling that Microsoft could probably do more. However, in my opinion, of the Mag 7 companies, I think Microsoft is the least risky in terms of potential market share loss, regulatory threats, etc. As an investor, you're getting great growth with less risk versus other Mag 7 companies. In fact, I was surprised to see that their beta, or the measure of the volatility of their stock relative to the index, was slightly higher than Berkshire's and is the lowest among Mag 7 companies. However, you will pay a premium at a 28 forward PE to own this company. Next, coming in as the fifth most commonly owned stock by these super investors is Amazon, ticker AMZN. I don't think retail investors truly appreciate how diversified Amazon is compared to the rest of the Mag 7. You have Google and Meta, which are both highly dependent on advertising. Microsoft is pretty much a pure software play, and Nvidia and Tesla are highly concentrated into their own respective single industry, but not Amazon. They bring a $400 billion marketplace, which is pretty much just a massive search business with a strong network effect, a world-renowned brand, and extremely valuable intangible data assets. But that's not it. They also have a $100 billion cloud computing business, which is the largest in the world. They have a $50 billion advertising business, and a $50 billion membership business centered around their Prime membership. And what gets me is that they're all growing 18% or more over the past few years. Having said that, their profitability leaves a lot to be desired because operating costs are so high as a result of their massive capital expenditures and research and development budget. Also, their low margin marketplace makes up 2/3 of revenue, which is that much more impressive that they're able to generate the 10% margins that they're able to. But at the end of the day, they're only keeping one out of every $10. The biggest knock on Amazon is the fact that they're still diluting shareholders. They're a mature 30-year-old company that generates billions of dollars of cash every year, and you're still diluting shareholders. What the F? But then again, they've delivered. Amazon has the highest return on this list over the past 10 years. They're a 10-bagger over the past 10 years, and they come with relatively few risks such as regulatory scrutiny due to anti-competitive behaviors and fierce cloud competition from Google and Microsoft. 6th on this list is Meta, ticker META. Meta is a great company and is growing the fastest of the Mag 7 companies excluding Nvidia. But they're also the least diversified. 98% of revenues are derived from advertising, which is a double-edged sword. On one hand, advertising is a highly profitable industry, which you can see in Meta's strong returns on capital and a 30% plus net margin. But on the other hand, any type of slowdown in advertising equals trouble for Meta, and ad spending is a cyclical industry. You can see it in Meta's metrics. But with 3 billion daily active users, Facebook is a huge network, and sellers would be foolish not to spend on their platform. Even if there is a drop in ad spending, it's likely only to last a year or so, maybe 2, so it shouldn't be a problem for long-term investors. Just understand that Meta's stock price will drop, and probably by quite a bit, when the inevitable slowdown in ad spending comes. And the last of the Mag 7 in the top 10 comes in at number 7, and it's the obvious one. Apple, ticker AAPL. That's right, Nvidia is not on this list. Nvidia is not one of the top 10 most common holdings of these super investors. For all the Apple naysayers over the past year or so, super investors have voted with their money, and as of the end of the last quarter, they're sticking with Apple. There's no doubt that the growth has slowed. You can see it in all their metrics. It appears that the pandemic and the associated move to work from home and stimmy checks pulled forward tons of demand into 2021. But an estimated 300 million iPhones haven't been upgraded since 2021. In my opinion, it's very likely that we see a massive adoption wave as AI gets worked into the Apple products and ecosystem. This is certainly what Dan Ives of Wedbush Securities thinks will happen.
You write in your note that you estimate roughly 300 million iPhones globally have not upgraded in over 4 years. So do you think this upgrade cycle is going to be led out of necessity because people are just desperate for a new phone? Or is it that AI capability that Apple's starting to introduce?
I think about 60–70% of it is that you've gotten to the point now where that's a pent-up upgrade cycle. It's really unprecedented for Apple. But also remember that install base, that's increased 200 million even over the last few years. So the install base continues to be the golden goose of Cupertino. But the AI-driven piece, it's just starting. That's why it's a get out the popcorn moment, because in our opinion, the consumer AI revolution goes through Cupertino. And I think, look, that's why the bears will talk about valuation like they have for years in Apple. It's about sum of the parts, about what AI adds to the story. We think it's $30 to $40 per share.
How hard would it be, though, for the next upgrade cycle, especially if so much is driven now by software updates? The hardware hasn't really changed.
Well, I think that's in iPhone 17. Again, that will be, what we'll be seeing later this year, into 2025. That's actually going to be a hardware-driven, a new form factor that's really going to be AI-driven. So that's why this is it's a 1-2 punch. It's 16 into 17. And that's why what makes this unique, it's about the increased services. And ultimately, you have hundreds of apps right now in development that are going to be on top of Apple Intelligence. And that's why the enterprise AI revolution's the godfather of AI, Jensen NVIDIA. The consumer AI revolution goes through Cupertino.
His thesis is full of future expectations, but they're reasonable expectations given Apple's dominance of the smartphone market. I understand the concerns of slowing growth and a high valuation, but Dan Ives is very likely to be right. Consumer AI implementation will go through Apple. I'd put the probability at no less than 95%, probably more like 98 or 99%. And a couple of weeks ago, they announced that they'll spend $500 billion over the next 4 years to accelerate their AI capabilities. Even Dan Ives would probably agree that Apple is no longer a growth company. We're probably looking at 6-7% top line growth at best. Now that we've covered the Mag 7, let's dig into the other 5 companies, and we're going to start with my favorite, the credit card companies, and they're coming in at number 2. I'm cheating a little here. Actually, Visa, ticker V, came in at number 6, while MasterCard, ticker MA, came in at number 10. But I'm going to combine the two because they are so similar, and it gives me an excuse to talk about more companies that are held by these super investors. Just for the record, Visa is twice as common as MasterCard in these super investors' portfolios. First, I want to address a common misconception with these two credit card companies. They do not lend money. They do not take on credit risk. The banks are the ones on the hook for credit card bills and the resulting delinquencies and write-offs, not the credit card companies. These companies are simply massive global payment processing networks with a stranglehold on commerce, and they charge toll to use their networks. They're incredible asset-light businesses that have built extremely wide moats based on a network effect derived from their globally recognized brands and fortified by switching costs that are as strong as any other company or network in the world. Not for consumers. It literally costs consumers $0 to switch to competing cards. But on the merchant side, if you have a business and you don't accept these two cards, you are severely damaging your business. And the thing that I think really puts these companies over the top in terms of quality is the fact that they have inflation protection built into their business model. Price increases for using their networks are not really even required. As prices rise throughout the economy, the average transaction amount naturally increases. And because they charge fees as a percentage of the transaction amount, their revenues naturally increase with the general price level in the economy. Revenues are growing around 10% per year, with MasterCard growing a little faster. And I like to refer to these companies as the 50% companies. They have 50% net margins, 50% free cash flow margins, and they return 50% of revenues to shareholders. Not earnings or cash flows, but revenues, all while funding internal investments at very high rates of return. Visa is my number 2 holding, so it's nice to see these investors corroborate my thesis. I personally chose Visa over MasterCard because of their respective debt levels. Visa is able to drive better profitability with a lower debt influence. MasterCard has a 269% debt to equity ratio versus 35% for Visa. Visa is just a more efficient company. There are some regulatory risks with a potential cap on interest rates that can be charged by the banks. I've heard some so-called experts claim that these caps would not affect the credit card companies, and this is nonsense. While the banks would be the ones that really take it on the chin, which is why I don't think that it's likely that a cap gets instituted, it absolutely will affect the credit card companies. It wouldn't be the end of the world, but it will affect their margins, because if the margins that the banks are making off credit cards gets reduced significantly, then they're going to issue less cards. It's just basic economics. And there will be pressure on the credit card companies to reduce fees that they charge to use their networks. The 10% interest rate cap that has been proposed is not going to happen. I'm almost certain of that. If any cap gets implemented, it'll be around 20%, which will end up being a nothing burger for the credit card companies. As far as the fintech risks go, I'm not the least bit concerned. Of course, in the top 4 is Berkshire Hathaway, ticker BRK, the massive conglomerate holding company with businesses in insurance, railroad, and energy sectors, to name a few. Berkshire is a steady Eddie company and investment with revenues growing in the 6-7% range. They're highly profitable, and best of all, they're trading at 1-time book value, which is incredible value given that it regularly beats the S&P 500. What seems to be the play here with these super investors is that they're putting a chunk into Berkshire Hathaway so that the portion of capital is nearly guaranteed to beat the S&P 500 over long periods of time. And then they layer on the higher growth tech and other stocks in an effort to increase their outperformance over the S&P 500. On a cash flow basis, it doesn't look so bright. They've been able to generate a poor 10% free cash flow margin, and cash flow in general have been fairly stagnant over the last 5 years. And they don't return much of anything to shareholders. That's the deal though. You have to trust Warren Buffett. He's going to hold cash and buy assets for you using his value investing approach at very opportunistic times. The risk with Berkshire is Warren Buffett himself. Once he kicks the can, the question becomes, will Berkshire ever be the same? Sorry, let me rephrase that. Berkshire will never be the same once Buffett is gone. The real question is, can they continue to beat the market? And we already got a glimpse into their approach with purchases of the pharmaceutical companies in 2020, TSM in 2022, and Ulta and Snowflake in 2024. All these investments, if you can call them that, were dumped shortly after the purchase, which is a deviation from how Buffett works and may signal a change from the Buffett style of investing for Berkshire's portfolio once Buffett is gone. This is the only reason I don't own this company right now. One day, we're going to wake up and Buffett will have met his maker, and I fully expect the stock to get hammered on that day and probably for a while thereafter until we see how the portfolio will be managed by his replacements. Coming in at number 8 is Intuit, ticker INTU. Intuit is the most well known for their QuickBooks and TurboTax software. These two products are the primary way they get customers in the door, but Intuit is much more than just a tax service. They also offer accounting, payroll, tax services, and even financial services over a cloud-based platform. And they focus primarily on small and medium-sized businesses and individual consumers. They've been able to build pretty strong switching costs, attributable primarily to brand recognition and loyalty, and to a lesser extent, intangible data assets. Intuit is doing very well, with a vast majority of revenues coming in the form of a subscription-based recurring revenue that's growing in the low to mid-teens with very high retention rates. They're reasonably profitable with net margins in the 17 to 20% range, but margins have been declining due primarily to the higher sales/marketing and R&D expenses. I view this as a short-term decline and fully expect their margins to bounce back to historical averages. They've been growing their dividend nicely at 15% per year, and they're returning 60% of free cash flow to shareholders, which is outstanding, until you consider stock-based compensation. Their stock-based compensation has 4x'd in the last 4 years. Let me repeat that. Their stock-based compensation expense has gone up by 4 times in the last 4 years and is eating up 1/3 of free cash flow as of the last quarter. This is not something you want to see from a company you own. I considered Intuit a couple years ago, but ultimately I decided to go with a more profitable and steady yet smaller competitor named Paychex, ticker PAYX, and I chose Paychex for 3 reasons. Paychex offers the full range of human capital management. They provide pretty much everything Intuit does, plus staffing management, employee benefits, and more. They provide the full range of HR services, which leads to their products and services being more entrenched in customers' operations, leading to much stronger switching costs and a wider moat. A common response that I hear when comparing these two is that Paychex is just too capital intensive, and it's true. Paychex's business model opens them up to more risks that are not faced by Intuit. But given this fact, an investor would expect Intuit to be a more efficient company, right? Well, that's just not the case. Paychex is a more efficient, better run company. They're twice as profitable with a 32% net margin and a 40% return on invested capital, and they're consistently generating a better free cash flow margin without all the stock-based compensation nonsense that comes with Intuit. And they're able to do all of this with significantly less debt. There are so many people who talk about how good a company Intuit is, and many times it causes me to question my decision to go with Paychex. But every time I go back and re-look at my research on these two companies, I walk away reassured that Paychex is the right decision. Don't take my rant as poo-pooing on Intuit. It's a pretty good company, and these super investors disagree with my assessment. But I want to let you know about an alternative as a way to offer extra value to my viewers. Ninth on the list is Moody's, ticker MCO, the credit rating agency. I'm going to talk about both Moody's and S&P Global because they're very similar. But for the record, Moody's is the stock that most super investors hold. S&P Global did not make the top 10. The ratings businesses of these two companies are deeply entrenched toll booth style businesses. That is essentially a duopoly with each one holding about 40% market share, while Fitch holds around 15%. Moody's was founded in 1900 and S&P 40 years early in 1860. And over the last 100 years, these companies have established deep relationships and acceptance from regulatory bodies and financial institutions to the point that they've created a de facto barrier to entry and switching costs. Currently, there are only 10 SEC-recognized ratings agencies in the world, and some banks will not underwrite a debt offering unless it has a rating from one of the top 3 companies. Also, Morningstar estimates that bond issuers are able to reduce their interest rate by 30 to 65 basis points by obtaining a debt rating from one of these companies. All of this translates into very strong moats that lead to strong pricing power. Historical data from S&P Global shows that they've been able to raise prices by about 3 to 4% on average. These ratings businesses are mature yet highly profitable segments that are growing in high single digits and form the foundation of these two companies. They both offer data and analytics services too. This segment has been the growth engine for both of these companies over the past 15 years, with 95% of the revenues in the segment coming via subscription plan. They're able to lock in their customers and keep them for the long haul. This segment has grown about 10% per year, with S&P growing a little bit faster, mainly because it's wide moat, world-renowned indices business. S&P's indices business and its relative valuation is what makes me choose S&P Global over Moody's if I had to choose one. Both are highly profitable. Both are highly dependent on financial markets. Economic downturns and uncertainty tend to hurt their businesses because companies are less likely to IPO, borrow, or enter into large contracts in such environments. Because of this, there is some minor cyclicality in their business, but over the long term, these two companies have as good a competitive position as can be. Cyclicality is just part of the deal. If you're an investor that is willing to buy semiconductor stocks, this is a cakewalk. S&P is growing faster and has slightly better revenue diversification, while Moody's is more stable, offers faster dividend growth, and has less debt. For what it's worth, super investors chose Moody's. Finally, we come to the 10th most common stock held by super investors in their top 10 holdings, and that is Taiwan Semiconductor Manufacturing Company, ticker TSM. It essentially has the advanced semiconductor market cornered at the moment. TSM is the company that makes semiconductors for pretty much all major players in the industry like Nvidia, AMD, Apple, Broadcom, Qualcomm, etc. If a chip company doesn't own its own foundry, it's almost guaranteed that TSM is their supplier. It has built a wide moat based off its vast knowledge of advanced semiconductor manufacturing and the extensive relationships that it has built over the past 40 years, and the massive costs required not only to build but run and maintain one of these foundries acts as a barrier to entry. Their only true competition comes from Intel and Samsung, both of which are struggling with turnarounds, so TSM has the industry to themselves at this moment. With AI gaining steam, TSM has posted an explosive growth of 22% per year over the past 5 years, and they've generated immense amounts of free cash flow, which gets reinvested at high rates of return, generating 40% net margins that are expanding slowly over time. You'd expect a company with these qualities to trade at high multiples, but not TSM. They're currently trading at a 22 PE and about a 3.4% free cash flow margin. So they're reasonably priced compared to many of these semiconductor companies, and is probably the main reason why super investors are so apt to invest in this company. However, there are some pretty serious risks which are the cause of the reasonable valuation. First is the huge amount of capital expenditures that they're spending in a highly cyclical industry, which means that the future returns are very uncertain. Second is the expected margin compression as they expand their operations into the U.S. Operations in the U.S. are more expensive than pretty much every other part of the world, which will put downward pressure on their margins. But the most likely cause is the geopolitical tensions with China. If China invades Taiwan, this stock would absolutely tank. We're talking 30, 40, 50% in a single day. Well, that'll do it. I'd love to hear your thoughts on these stocks. Do you hold any of these stocks? Are you buying any of them during this dip? If so, please let me know in the comments. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. Lastly, if you're interested in other high quality companies that could be good buys right now, click one of the thumbnails that you see on your screen. Until next time, you all take care. I'll see you in the next one.